Welcome back. I'm your host, Tom Bruni, and you're watching another edition of What the FICC, the weekly show where we discuss the most important chart or theme from the fixed income, commodity, or currency space. Last week we discussed the breakout in US Treasury bonds to new all-time highs. We discussed what the drivers of that breakout were and how we were taking advantage of it. If you missed that video and want to catch up, you can click right here. But if you've already seen it and want to jump right into this week's topic, let's get into it. Natural gas. Before we get into the specifics of natural gas, I want to take a step back and look at the Commodity Continuous Index, which is an index that equally weights 19 commodities across the metals, agricultural, and energy space. It really is a broad-based measure of how commodities are performing as an asset class. And in March, we saw them test their 2008-2009 lows as risk assets sold off. The good news is, prices held those lows and have been trending higher since. It's not just precious metals and base metals moving higher on their own. No, for this index to move higher, we need broad-based participation, and we're getting it. And we think the next major beneficiary could be natural gas. First, let's start with a weekly chart of natural gas futures, looking back about 5 years or so. The 160 level has been a key level of support ever since 2016, where prices bottomed. And coming into this year, we knew that this level would likely be tested. Well, we got our test, and it was successful at first, but in June, prices actually broke below 160 before quickly recovering. That failed move below 160 is the catalyst that we think is ready to kickstart this new bull market in natural gas. I also want to point out that momentum never got oversold during this sell-off, signaling that sellers were becoming exhausted and the transition to buyers being in control was likely in progress well before we saw this price breakdown. In the weeks since that breakdown, we've seen prices accelerate to the upside, and not just on an absolute basis. On a relative basis, we're also seeing prices bottom relative to the CRB Commodity Continuous Index we just spoke about. What this is suggesting is that as long as that ratio is above its 2016 lows and momentum is out of oversold territory, natural gas is likely to outperform its peer group, meaning commodities as an asset class. So we have our key level, 160 in natural gas. If we're above that, this could be a new bull market. We could see prices back toward $4 in the coming months and quarters. So how do we take advantage of it? Well, the easiest way would be to just trade the futures, but a lot of people don't have access to the futures market, and since prices are trading around 220 right now, it's very difficult to hold a position all the way down to 160 without getting stopped out. Futures have a lot of leverage inherent in them. So, one alternative is to use the natural gas ETF UNG. There are a lot of ETFs out there, but UNG is one of the most liquid and popular vehicles. But in this case, we don't want to just own natural gas. We think there's an opportunity in owning the individual stocks that would benefit from higher natural gas prices. So, in order to pin some of those down, we looked at the FICC ETF, which holds natural gas stocks, and we went into the components to find those with the most asymmetrically skewed risk-reward ratios. Names like Range Resources, ticker symbol RRC. A lot of these energy stocks have been absolutely decimated since 2014. Take RRG for example. It's fallen from nearly $100 down to $2 in March, and now has recovered slightly. Luckily for us, we wanted nothing to do with these stocks when they were in a downtrend, but now that they're attempting to reverse those downtrends and move higher, a large short interest and negative sentiment is an opportunity for us. More importantly, a lot of these stocks are showing bullish momentum divergences and recently put in a failed breakdown below key support, just like we saw in natural gas. In the case of Range Resources, prices broke below key support near 450, traded down to about $2 and quickly reversed. Now, as long as prices are above that 450 support level, we think the bias is to the upside. And it's not just on an absolute basis. We're seeing it on a relative basis as well. Look at RRG relative to the natural gas stocks ETF that we first analyzed. Doesn't look like a long-term uptrend to me, but it also isn't a downtrend and continues to improve over the intermediate term. These are the types of stocks we want to own. Those with well-defined risk, negative sentiment, large short interest, and a lot of potential to move very quickly in the event that we get this right. So let's review. Commodities as an asset class are continuing to recover. While they're not in a long-term uptrend, they're also not in a downtrend either. Natural gas sticks out to us as a long-term bearish to bullish reversal. As long as prices are above 160 in natural gas futures, we think the bias is to the upside and want to be long towards $4 in the coming months and quarters. Now, if you're not trading the futures and don't want to use the ETF, a great way to play this is in some of the smaller energy names that have been absolutely decimated since 2014. Today we're looking at Range Resources. As long as the stock is above 450, we want to look for further upside toward 21.5. That would be a massive move from current levels. And more importantly, our risk is well defined. So if we get this thesis wrong, we know exactly where we're wrong and where we're getting out. Friday afternoon on allstarcharts.com, I outlined this full thesis. So if you'd prefer to read it and want to recap, as well as the other stocks we're playing, head on over to allstarcharts.com/blog and check it out there. That's all we've got for you today. If you enjoyed this content, make sure to drop us a like and comment down below. We love your feedback. Also make sure you're subscribed to the channel. That way you don't miss any updates from myself or the rest of the team here at All Star Charts. Thanks again for watching, and I'll see you guys next week for another edition of What the FICC.